yeah, there we have it. It's about actuarial modeling techniques, and I added, for my sake, in wider fields. And then the question is, are there any best practices and innovations that are happening out there that we ought to be aware of? And I actually thought it would be nice if we can propel a rocket from a laptop. So those are the kind of innovations we're talking about. The agenda looks long, but it's not as long as it probably looks on that slide. Just a brief intro on why the session, and like we said, banking is a wider field in the actuarial space. So share some of my experiences from a banking point of view, from a microinsurance point of view. Then it always helps to go back home, which is life insurance, that being the stable of the actuarial world. So also maybe discuss what's happening and what are some of the best practices that one has seen along the way. And then I think this is a very, I would say, introspective presentation. So what I share to a large extent are my own experiences and maybe of the institutions where I've worked. Finally, where do I think the direction is, and well, should have some good time for Q&A. I don't think we will take the full 2 hours. In fact, I think 2 hours is too long, so we should manage to save some time for all of you along the way. And why are we talking about innovation and actuarial modeling, yet the actuarial space is considered one of the best places to work in? I think the point is you never want to be too comfortable in whatever profession you are in, right? And the story is often told of Kodak and how they thought they were the best in the camera space in the 70s and 80s, and they felt actually they couldn't become an extinct company. And fast forward 30 years, that's what happened. And maybe to juxtapose that with Netflix, which started as a movie rental company, and when they tried, when the guy who started Netflix tried to sell it and tried to sell the concept of Netflix, which is having movies online, he was told that can never happen. It's a dream, and then he couldn't sell the company at the time. That was in the early 2000s. And right now, I'm sure he's probably grateful that that never happened. So you never want to get too comfortable wherever you are in. And it's always good to explore what's happening in your field. And that's pretty much the thinking behind this session. Let's explore what's happening in the actuarial space from a modeling perspective. And in so doing, we understand what are the current risks, and are we able to have a sense of the future trends, but both from a actual modeling point of view, and the development of the actuarial products. So I'll jump into one of the two wider fields that I'm discussing, which is banking, right? And I'll borrow from a slide that I used at the task convention last year that speaks to the banking space, right? I actually think for one to assess what's the role of an actuary in banking, you want to at least look back or look into the credit decisioning process within the bank, right? And if you think of a typical, what happens in a typical bank, the customer walks in or goes online, and it doesn't matter whether it's a retail customer, that's you and me, whether it's a business, or whether it's a more complicated structured finance for your corporate finance projects, right? There's a customer who comes to a bank and they're looking for something. Could be the service, it could be debt, but there is a front line, and what that typically will entail is just collection of basic customer data. As you will suspect, the actuary normally wouldn't be needed at the frontline phase. And then, as assuming that the customer is coming to take a credit product, then the next step is to assess whether the bank wants to actually get this customer in, right? And so they take the data and they analyze that data. At that point, they can do a credit worthiness assessment of the customer. So obviously in Kenya, there was the issue of the credit bureaus. So in a country like South Africa, the credit bureaus are very well entrenched in the banking system. So even after you've come through the front line, the bank can decide whether they want you or they don't want you, because once they have your ID number, they can access your credit worthiness using the information that's in the bureau from one of the many bureaus that are accepted. And obviously, this is based on how the credit worthiness works. It's based on credit scores, and the credit scores are built off the financial history of the customer. So that's the first place in a banking journey where an actuary would be needed. So when it comes to the building of the framework from the credit scores and ensuring that the information that the customer is giving you, whether the customer is giving you very little information or a lot of information, you can make sense of it and be able to decide whether that's a good customer. You're talking about modeling, and you're talking about using data to be able to predict whether it's a good, it's an average, or it's a bad customer, and whether you want such a customer in. And then once you've decided that you want that customer in, so remember, the decisioning engine has nothing to do with what offering the customer a product. It's just about the customer. Is this a good customer or is it a bad customer, and do we want them? And once the customer has passed through that actuarial model, then what typically will happen is the customer probably wants a loan product in whichever form. It could be a normal loan, it could be a mortgage, or it could be asset financing, a different form of asset financing. Then you're talking about pricing this customer. Now, in the olden days, you would just want to walk into a bank and based on how the manager looks at you, feels, then they will decide, we're going to give you this loan on these terms, and that is it. Now, in the modern banking space, the customer, you cannot assess the customer that way. And an example would be someone like a doctor, right? So there's a doctor who's going to medical school, they've finished medical school, their internship, and then probably even their master, so they're a specialist. And they come to you and tell you, we want, or I want you to finance my practice. I want to start a practice, and I'm a neurosurgeon. So will you finance me? Now, if you were to look at the total financial health of that neurosurgeon at that point, you probably would say, no, we can't finance you. But that's a bit retrogressive, if I can use that word. What the modern banking space wants to do is look at the lifetime value of that neurosurgeon, right? So if we're able to finance that neurosurgeon, or be it a dentist, to buy the equipment for their practice, and that neurosurgeon stays entrenched with us, and the business grows, then the bank as a whole, when they look at the lifetime value of that customer will be profitable to the entity. And in so doing, then you probably won't be very punitive to that doctor, even when it comes to the terms that you give for the loan, off the loan. And that's the other place where an actuary becomes quite important and helpful. I think for long we've been involved in projecting the life of an individual, the mortality of an individual, in a very mortal sense. And how about taking those techniques and applying them to predict the life of a banking customer? How long will this customer stay with this bank, and what value will they bring to the bank? And then after that, so then we have a pricing engine, we have a robust pricing model that has been built by an actuary, and that actuary, the model says, let's accept the customer. Then what happens after that is more legal and compliance. We're talking about documentation and onboarding that customer. So finalize the terms. If there is any collateral that's been taken, then that's taken, and the customer is introduced to the banking services. So for documentation and onboarding, being a legal and compliance area, you typically won't have the actuary there. And then on a day-to-day basis, because we've given this customer a product, then we need to, when a bank gives a loan to a customer, the unit that's giving out the loan must borrow that money from another unit, right? And that unit is normally called the Treasury Department. So on a day-to-day basis, and if you were to think of along the way, we've just talked about one customer, but by the time you get to 5, you're talking about thousands of customers. Then there has to be that management of, this is how much money we are getting from the Treasury, and this is how much the Treasury is charging us, and we should be able to, we are giving this money to our customers out there. What's the balance? How is that looking? And also, there are also customers that are depositing money into this institution, right? So there are very many areas within the financial management where an actuary can be involved. So asset liability management is a place where actuaries have been involved in the traditional sense, from a life insurance point of view, even from a short-term insurance point of view, ALM has been there. But now, and especially from a short-term insurance space, the same techniques that are applied in the short-term insurance space would typically be applicable in the banking space. Think in the life insurance space, you're talking about very long-dated policies. And then you have your portfolio management, and here you're talking about things like ensuring customers are not going into default. And given our good understanding of risk, right? A remark was made that The good thing with actuaries is they understand risk, but they're not scared of risk. So we're able to quantify risk, and we can make sense of it, both for now and for the future. When you think of aspects like now ALM, portfolio management, and the treasury within the banking space, the actuary can apply themselves quite well there. And finally, now, from a customer point of view, we need to have what we call relationship management. And this is an area that has grown out of big data and data analytics, right? Once you have a customer, don't just assume that this is it, we've gotten the customer. The concept of a customer having evolving needs has started to become key. So if you were to think of a retail banking customer, when they come to you, probably they've just finished their studies and they've just entered their workspace. And then fast forward 5 years, they get married, they start getting kids. You want to be able to predict or move with that customer. As they start a family, are you offering them products that are very specific to them at that point? And you're talking about data mining, looking at the transactional data of these customers, probably seeing that they got deposits for a baby shower, or maybe if they're traveling, you can see that from the transactional data, based on data mining, that they went to a travel agent and they paid for a ticket. Are you able to offer them a product that will help them as they take their holiday, family holiday? And we're talking about a lot of models there. The one of the models that we discussed in the pricing engine becomes important. The lifetime value of the customer once again, but also adapting to this customer as their needs change. And it's not just about giving them products, but also ensuring that you're able to manage this customer. Are you able to build a model that can predict a customer who's likely to go into default or become high risk? So that's the last space where an actuary can become involved in the banking space. And so if you look at the chain or the journey within the bank, there are very many places. In fact, it's only 1 in 4 where an actuary can't really bring in their expertise. For the other 4, the input of the actuary would be quite useful. And so I think following on from that, it's about us building models to assess credit risk. And then credit risk, we're talking about the risk of the customers not repaying. Market risk, obviously, it might not necessarily be an actuarial domain. One could think that people who've probably gone into the CFA route are better placed, but we also have that specialization within the actuarial journey to be finance specialists. And things like op risk, these are evolving areas, and op risk has not always been quantified. But how do we use our knowledge to start quantifying what has typically in the past been known as a non-quantifiable risk? And yeah, we're talking about pricing. We did discuss this. And sometimes it will be simple financial products. Sometimes it will be complex, but more especially for the complex financial products, where the pricing is not so basic and the input of the actuary is useful. when it comes to regulatory compliance. Obviously, with things like Basel principles, that demands or requires of us to ensure that we are stress testing, or even when it comes to the very basic parameters that one would use in banking. And then that's also from an IFRS 9 point of view. When you're talking about the probabilities of default, it's you can compare the probability of default to your QXs, which is your mortality rates. And also the other big parameter is your loss given default. We have the knowledge to be able to calculate that, or to even build robust models, and that's the expectation from a regulatory point of view, that we can go to the banking space and apply our skill set there. And like I mentioned, big data and AI, segment your customer and grow with them. And so what are the examples of this in banking? I think I've mentioned this as we were moving through the journey. It's about building credit scoring models, but not the basic credit scoring models, because the credit scoring models have been there. I think we are not the ones who are bringing this to the banking space, but how can we use a skill set to help in the building and implementation of advanced scoring models that very well take into account our understanding of risks within the environment. Actually think blockchain will also be an important tool into the future, particularly for collateral. I talked about portfolio management, and if you're going to do portfolio management, then things like blockchain are helpful, important, to ensure that you're taking enough collateral as needs be, but you're also not taking too much collateral. So remember also, keeping collateral comes at a cost. So if, for instance, you want to take title deeds from your customers, the fact that these ones must be stored in a safe, you don't want to take more than necessary, because that comes at a cost to the institution. Then, can we do predictive analytics? What's the next best product for the customer? Or can we predict that based on this, on the trajectory this customer is in, they're probably going to default? And if you're able to build that, then you can almost protect yourself against losses early on in the journey. And the outcome, we're talking about reduced defaults, reduced credit losses. You're talking about being able to offer products where needed, and ultimately increased profitability for the bank. I always say that, and it's not just in the banking space, but most especially in the wider field. If you're to be able to convince the management that your input as an actuary or an actuarial input, it will become useful or is helpful, you need to be able to show what's the impact on the bottom line, what's the impact of what you're doing on the income statement and balance sheet. And for as long as you can take that extra step and be able to show that by reducing this default, we've saved this much on the credit losses, and as a whole, our income statement looks much better, right? Or because of doing this, then the reserves that we are holding on the balance sheet are not as high. Then the management starts appreciating the input that you're bringing in as an actuary. And then jumping into microinsurance. So why do we have microinsurance? We're talking about the previously uninsured, underinsured people in the population. And especially when you think of a country like Kenya, and then you walk down Moi Avenue, think about all those traders, or even the farmers, the people who don't have medical cover. We're talking about an insurance that's simple enough, yet comprehensive to be able to provide solutions to these people. And what's the role of an actuary here? Product development. It's about designing affordable and relevant insurance products for these customers. Now, affordable because these customers typically won't have a lot of money. It probably might be the adverts that sometimes you'll see that say, pay for your product daily, right? But it's because psychologically, if someone is paying only 10 shillings for a product daily, they might not feel that pain compared to them paying a monthly amount. So you want to design the products such that it's affordable, but it also needs to be relevant, right? So if you go up country, a farmer in Kitale might not be interested in a life product. It could be a life microinsurance product and it's cheap, but that's probably not their biggest worry. They're worried about the rains and whether they'll be able to farm properly come this year. So then for that farmer, you're probably going to look more into agricultural microinsurance and not necessarily life microinsurance. And then I guess, yeah, affordability does speak to that. You're talking about pricing. Once again, as an actuary, you need to be providing risk-based pricing. It's not just about giving every or going to every area and offering farmers insurance. Otherwise, if you were to do that, you're going to ban. So you need to also have done your normal, I'd probably call them experience investigations in quotes, for you to be able to do your risk-based pricing. But the challenge with microinsurance is that you've got limited historical data. So what do you do with this data scarcity? You are forced to do incremental product development. So whereas in a very developed actuarial area, you can sit down as a product development team and develop a product from beginning to the end with all the frills that you want. In the microinsurance space, you probably don't want to do that. You want to do incremental product build as you get more data along the way. And then from a distribution point of view, and maybe I should mention, in the microinsurance space, the actuary is typically involved across the whole value chain, right? So whether it's product development, pricing, distribution, or the operational aspects, the actuary will typically be involved. So in the distribution, you probably as an actuary or providing actuarial input to the management, it's about giving guidance. So how do we reach this underserved population and what's the best practice out there? It's been proven for the microinsurance space that mobile technology has helped quite a bit in the penetration. So probably looking into those channels. And like I said in my ending statement around banking, when you look at the bottom line, if we were to use a mobile technology vis-a-vis brick and mortar stalls, how does that look like from a income statement point of view at the end of the day? And yeah, the innovation obviously does speak to that. If you're able to sell products using mobile technology, it probably will be easier. And for as long as it's incremental, then you're able to assess the evolving risk of the customer on an ongoing basis. Then examples of our role there and how has it helped and how will it continue to help. Using that mobile data means we can be able to offer dynamic pricing and move along with the customer. Talking about parametric insurance model and index-based crop insurance. And then I know a lot of work, particularly funded by your supranational organizations, your UNs, is being pushed into, for instance, crop insurance. So that's one good area for an actuary within the microinsurance space. And what are we looking at? What's the impact of us putting our actuarial expertise there? You're talking about increased coverage. If you think about people who live hand to mouth, the farmers who lose a whole year's worth of earnings because the rains failed or because there was flooding, by virtue of actuaries being there and helping in the I almost want to say in the development of these products and subsequent distribution, you're helping these farmers, you're helping this sick patient, and I think it is a good place to be, right? And you're making sure that if in the unfortunate event that something was to happen, these people don't just go to banks and get loans and the cycle continues. So for me, that has been one big appeal of why we should be in the microinsurance space as actuaries and help. And then just looking at the more traditional life insurance space and what's been happening there. I think mortality for your risk products, longevity for your annuities, and obviously we know the trends, whether it's your life expectancy and the health trends are evolving. And for instance, in South Africa, the issue of personalizing your risk assessments has become a big thing. And I know one could argue that no, underwriting was being done before, which was very personalized. But now here we're not talking about an underwriter calling you and asking you all sorts of questions. When did you last see a doctor? We're not talking about that. Now we're talking about building models as actuaries that help with a personalized risk assessment of the customer without you necessarily having to ask the customer questions. And then reserving, obviously, that becomes an ongoing important aspect. I think most of you would probably, in any case, be busy with IFRS 17, probably not sleeping. And as we move from IFRS 4 to IFRS 17 and future iterations of IFRS 17, that keeps us busy. And innovation, I wanted to get to this point because it's linked to product pricing. Now, when we talk about personalized assessments, we're talking about, as you wear that Apple or Samsung watch, how can that data that's being generated be used to encourage you, one, to live a healthier life, but two, to also offer you personalized premiums for the effort that you're putting in. I think it's a term that was coined in Harvard called shared value, and it's about starting to build life insurance industries or companies that seem or are providing this shared value to their policyholders. And yeah, so just speaking to that, dynamic life insurance products that adjust premiums based on lifestyle choices. And there could be an ethical, one could ask about the ethics and whether using a customer information is ethical enough. I think there is a fine balance. You obviously don't want to ask for the DNA of a customer so that you can adequately price them. But for instance, how many steps are they doing in a day, and incorporating such things into your product pricing models. And as we get more data, there's a portfolio mix, what a customer needs today. In fact, for a life product, it's probably not the same product that they'll need 5 years from now as they get a family, as they take a bond. And can you build this needs-matched life insurance product that will evolve as the needs of the customer evolve? Pretty much like I was talking about in banking. And I'm not talking about heuristic or pie in the sky thinking here. I think these are things that are happening. For instance, there's a company called BrightRock in South Africa that's doing this. It's about needs matched insurance. Discovery Life in South Africa is doing a lot of this shared value life insurance. In fact, if you want to get an Apple Watch, they will give you a discount for as long as you allow them to then collect that information and use it. If you don't, then you would have to refund the rebate that you got from buying that actually Samsung Apple Watch. And what's the outcome of our involvement there? Healthier lifestyles. I think that's helpful. You're talking about personalizing premiums, but in a more agile and smarter way, because we've built the underlying models. And overall, and I think that concept of shared value is quite powerful. You're talking about increased customer satisfaction. Then best practices in actuarial modeling, data quality. I think it's a well-known fact that we've been taught along the way, garbage in, garbage out. So ensuring that the data that we are using is reliable, looking at the currency, is it recent data and is it helpful? Obviously, if you're looking at a specific organization, I think that the actuarial practice notes normally do give guidance that use as much information as you have for that entity before looking for industry data, for instance. And overall, that goes into ensuring that your model is accurate. Transparency, and this speaks to probably the modeling exam that we do as part of our studies. I think gone are the days when actuaries would sit at the back and just build very complicated models. In fact, it's quite important nowadays that the models that we build are understandable and explainable to management. if management cannot understand what we're doing, then they don't appreciate, right? So what are these models that we're doing, and how, in the end, do they help with the bottom line? Then ethics, it's about ensuring fairness, right? In the microinsurance space, for instance, are the products you're offering fair, or are you just loading? After taking into account risk, are you just loading profit margins onto those products, or are they fair? What data are you using? I've given an example. It would not be considered appropriate for us as actuaries to propose, for instance, the use of DNA in life insurance pricing, whereas that would be a very good predictor of mortality. Is it an ethical thing? My gut feel says no. And like I said at the beginning, it's about continuous learning and staying updated. Actually, I think as actuaries, if we don't get very close into gelling what we do as actuaries with the changing landscape of modeling, whether it's about learning Python or whatever softwares are out there, then we will be left behind. So how do we ensure that we stay relevant? Someone was saying that when the spreadsheets came out in the 80s, actuaries were a bit adamant actually to jump into these spreadsheets, and it took a while for them to be convinced that the spreadsheets can't take your work. They'll actually make you do way more work. And it is the same here, right? As AI and machine learning become an integral part of the society, how do we adapt and adopt this to help us do our work more smartly and ensure that we are keeping up as well with the regulator who will always be on our heels. And then the future, and where do I think we are going? Like I said, AI, machine learning, I don't think that's going anywhere. I think it will become a core part of the future. So it's about us accepting that and adopting it and seeing to what extent it can help us in our predictive accuracy. Blockchain, I spoke about that. Telematics and IoT. How do we use all this information that we are getting to help us with dynamic pricing? And also an area that has come up quite a bit in the more recent years, months, years, is on sustainability and the role of actuaries in climate change. And I think moving on, we should see our skills being required quite a bit in that space. There's my email address. Feel free to pop me an email and ask me any questions that you might have on the wider fields. I'm always happy to share my experiences. If you want to chat about the exam journey, if you're feeling frustrated, pop me an email.